I believe that all of us can attest to that. Those are very, very, very good questions pertaining to insurances. And thank you, Coach, for your dedication to the success of others. We want to thank God, and we want to acknowledge that we are learning. We are learning as a result of this. We are learning from her. We are learning from the series. Today, we want to talk about managing risk. Managing risk and insurance. Risk management and insurance. Maybe as a way of beginning, I just want to state that we are surrounded with risk. There's no place you can go in this world where there's no risk. Oh, I just realized that my video is not on. Let me try to do that. All right. I'm saying that we are surrounded by risk everywhere. Everywhere we go, there is a risk. There is no place you can go in the world where there is no risk. There is no place you can go in the world where there's no risk. Living is a risk. Living is risky. While living is good and we love life, there are a lot of risks that are involved in it. Driving is fun and it's effective because we cut a lot of time. But driving itself involves a lot of risk. The person who's walking and the person who's driving, they have different kinds of risks. Flying. I can start flying right now, and by tomorrow morning, I could be in Kenya, where Beatrice is, or in Botswana, where Rachel is, right? But flying itself is risky, right? Eating is risky. Eating, while it benefits us, when you go to a restaurant to eat, you are eating food. Number one, you don't even know the person who prepared it. You don't know if they wash their hands after they use the bathroom. You don't know if they have their own communicable disease. Sitting down in a restaurant to eat involves risk. Now, starting businesses is a risk. What am I trying to say? I'm trying to say that we cannot avoid risk, but we can manage risk. The question is, are you covered? All the things that we talked about are inevitables. They happen, right? We said life is risky. And the last time I checked, 1 out of every 1 dies. There's none of us who is going to get out of this life alive. Should that happen, are you covered? Is your family covered? Is your spouse covered? Is your business covered? Are your investments covered? So today we want to really, really focus on how to manage risk. And one way of doing that is by purchasing insurance, right? And I know, based on my culture and the place of my origin, that these conversations like these are very uncomfortable to have, because culturally we tend to avoid things that talk about death and risk. We believe that talking about death is inviting it. But the reality is that even if we don't talk about it, we still die. So we have to normalize the conversation on death and preparedness, because death does not only come to those who have insurances, it comes to everybody. And I often say that when you go to a funeral of a person who was prepared, yes, we cry because we're going to miss them, but we smile because we know that we are better off financially than they were alive, or we are better off financially than we were when they were alive. So the question is that the reality of your family? Will your family be better off financially when you die, or they will be worse off when you die? A person who is prepared and who's covered and whose family is covered, they don't panic because there's a plan. There's an exit plan. Do you have an exit plan? Right. So what we are saying here is that, number one, we have to normalize conversation on death. I'm not sure if Rachel is still alive, is still awake. I want you, Rachel, to write in the chat like you always do. Thank you, Rachel. Thank you, Rachel. Beatrice, please help Rachel. I like you guys when you both write. I said we have to normalize conversations on death preparedness. We have to normalize that. Do your people, your children, know whether you have insurance or not? Have you asked them? So, Coach Lucy shared types of insurances that we can purchase, right? These purchases are an investment in your family and in your children and in those that you have identified as beneficiaries, right? So, what is insurance? If I may ask, what is insurance? What do you believe insurance is? What is insurance? I just want you to think, what is insurance? So insurance is a means of managing financial risks. Right? Insurance is a means of managing financial risks by transferring potential losses to the insurance provider or the insurance company. in exchange for regular premium payments. So you are saying, hey, Mr. Insurance, I have a potential risk factor. I may die, I may get sick, my car can get in an accident, right? I may be disabled. All these are risk factors that are possible to happen in my life. So, Mr. Insurance Officer, Mrs. Insurance Officer, Miss Insurance Officer, I want to transfer my risks to you so that when the inevitable or the perceived happen, I want you to cover me. And in exchange for that, I will give you a premium on a monthly basis just for taking the risk from me to you. So what happens is that Mr. Insurance, the insurance company says, oh, yeah, sure, let's do that. But let's examine you first to see how much risk you have. And then they ask you, how much do you want to be covered? Right? And then the insurance takes over the risk factor. And then you now give them a monthly premium. Guess what they do with that money? They take that money, they invest it. They invest it, right? And they're counting on the fact that people are actually honest and they have integrity, that they will not invite or cause the loss themselves. And also that they're counting on the mix of young and middle-aged and old people in the same pool where we share the risks, right? While old people die, eventually, some young die as well, but when a young person dies, it's usually through accidents, right? So that is what insurance is. The Bible highlights the importance of prudent planning and being prepared for uncertainties. That preparedness for things that we are not sure whether they'll happen or not, and even some that we are sure will happen, is what is the principle behind insurances. So Proverbs chapter 27, verse 12 says, the prudent see danger and take refuge, but the simple keep going and pay the penalty. I mean, the Bible couldn't be more specific. The prudent see danger and they take refuge. But those that are simple, those that are unwise, they just keep going and they pay the penalty. This principle of preparedness for the eventuality or preparedness for things that we know may happen or may not happen, that is the core principle of insurances. Now, let's talk about now the types of insurances that are there. The types of insurance that are there. Number one is health insurance. Now, what is the purpose of health insurance? Now, health insurance covers medical expenses for illnesses and injuries, and also some cover preventative care, right? And any insurance that understands the value of preventative care, they actually must encourage their customers or their clients to participate in preventative care and for them to cover it, right? Because when they cover preventative care, then it ensures that the person stays healthier. And when a person stays healthier, then their risk factors are lowered significantly. So the cost of medical treatments, one stay in a hospital, 1 day stay, can run you into tens of thousands of dollars, depending on what procedures they are carrying out in you, right? And the question is, should that happen to you, are you able to take money out of pocket and pay for medical expenses? There are countries where if you do not have insurance and you don't have money to pay for medical expenses, you won't get treated. This is reality, right? But there are also some countries where if you don't have insurance, the quality of treatment is lower than if you had insurance. They give you the bare basic minimum. So as a result, if there's medication, if there's a medical procedure that is expensive, they will never give it to you as an option because you're not able to pay for it. Should there be a surgery that is an option to treat the disease so that you can live longer, they will not give that to you as an option, right? Imagine that. There are some countries that do that. That's why it is very important to those that are able to have some insurance, some health insurance of some sort, right? Sometimes you may want to increase the deductible so that the premium, monthly premium, is lower, right? So it is very important. For example, if you are younger, if you buy your insurance while you are still young, your insurance premium, the monthly premium is lower than if somebody is older, even with other insurances, except auto insurance. With auto insurance, it is exactly the opposite. The younger you are, the more expensive it is, the higher the premium, because they believe that the younger you are, the more prone you are to trying crazy things because of just the age factor, right? So, but with all other insurances, the older you are, the more expensive it is. The younger you are, the cheaper it is. So you might want to consider that. Providing, remember we always talk about provision, right? Which is that providing for our family doesn't just mean providing food and shelter and everything, but it should also include providing in the event that we are incapacitated. Are you able to still provide? In the event that you lose your income, are you able to still provide? You can, if you have the right insurance. And we are going to talk about those insurances. Number two, type of insurance is auto insurance. Auto insurance. Auto insurance covers the cost related to car accidents, car theft, and damages. Vehicle, or even as long as it's new to it, may be used as long as you're registering. It may be required in some countries and some states, right? So some auto insurance also cover health expenses that come as a result of the accident. What it means is that if you're involved in an accident and you get hurt and you need medical attention, the auto insurance covers for your medical expenses. Right? Yes, you may have health insurance. In the health insurance itself, there are also health insurances that cover accident cost. Right? So you have to understand that if you have an auto insurance that covers health related expenses, you may want to notify your medical insurance people. Usually they will lower the premium because you already have your auto insurance covers medical expenses that are related to an accident, right? So when you tell them, hey, and they'll ask you, well, how much are you covered? And you can get that information from your insurance agent, and you give them. That usually drops your health insurance significantly, right? Number 3 type of insurance is life insurance. Now, this one here has many types of life insurances that we do not have the time in this session to expound. We are going to do this one on its own because it's one of the most important. Right? Life insurance provides financial safety net, not for the person that is insured, but for anybody they have indicated as the beneficiaries, which in the majority of cases is the spouse and children. Right. So insurance doesn't benefit the insured, the person who is purchasing the insurance. Life insurance benefits the beneficiaries, the people that will manage your finances after you have passed away. So it's one of the most important things, and not only that, it is one way not only of generating wealth, but also of preserving wealth, and also one way of transferring wealth to the next generation. All right. If you choose the right kind of insurance and you purchase early, right? What it means is that when you die, or when it reaches its maturity, the amount of money that your beneficiaries are going to inherit is so much. I mean, it can be in the millions of dollars. Actually, I do not recommend, if you are able, I do not recommend any insurance that does not cover more than $1 million. Why? Especially if you started younger. if you start that insurance young, you may realize that your premiums are next to nothing, right? For example, if you start a young child from the day they are born, I think there's insurance that mandates you to buy it when a child is less than 3 days old. If you take that insurance, you may be paying like $10 a month, right? But the sum assured could be in the millions of dollars. Imagine that. And the insurance is like that. And when that person dies, those that remain behind have enough financial resources to cater for the rest of the family's life and go into the second and third and fourth generation if it is well managed. And we will talk about, like I said, we are going to come back and talk about life insurances because there's a way of also doing that, which is one of them. I have to say that it is never a good idea to make your children beneficiaries of a huge sum of money from insurance payout. Why? It's because if you die and they are minors, they cannot benefit from it, number one. Number two, the insurance company might have to keep that money until the children are of age, or somebody, which is the most painful thing, is that someone in your family will have to assume a parental position and now is going to make decisions on how that money is going to be used. And in the majority of cases, and I cannot even begin to tell you how people use that money for themselves. And the people, they're your children that you actually planned for. In some cases, they never get a penny out of it. That is why it is never a good idea to make your children beneficiaries. The best way is to create a trust and make the trust the beneficiary of your insurance policies. Now, and you put rules in there so to manage the distribution of that. If you don't know how to do that, that's why there are professionals you can pay for them to do that. It's not a lot of money that you will pay to do that. It's a very minimal amount, but that is the best way that you can ensure that your children benefit from your insurance, not some disinterested uncle or sibling who may squander the money for your children. The same with parents. I also see the same mistake that young people who are not married, right, they make their parents beneficiaries of those insurances without putting it in a trust, which becomes, again, complicated. A blessing can end up becoming a curse, right? Or they'll end up being poorer than they were before they received that. So it is important that you make plans for the distribution of the insurance payout. Do not allow for you to die with insurance and there's nobody who is ready to assume responsibility. Like I said, a trust is the best way to be the beneficiary for your insurance. Like I promised, life insurance is a big thing. We have to come back to it. The Bible says in Proverbs chapter 13, verse 22, a good man, a good person leaves an inheritance for their children's children. but the wealth of the ungodly is left for the righteous, right? One way of leaving an inheritance for your children's children is by having life insurance. To be honest with you, there is no better way to leave wealth for your children than an insurance policy. It's like you don't work for it. You don't work for it. You just, all you do is just die. And the day that you die, a check is written into the trust, and you have broken the back on of poverty for the rest of their lives and their children's children. Right? That is if you do it right. The fourth type of insurance that we're going to talk about today is disability insurance. Disability insurance. Disability insurance is aimed at replacing your income, right? In the event that you are unable to work due to disability. And it may be temporary disability or permanent disability, right? So what it is will depend on the policy itself, right? This type of policy is very important, especially for people who rely on their salaries to put food on their table, support family, right? With business, it's different, right? If somebody is an entrepreneur who has a business, even if they die, if they had systems in place, the business will keep growing and generating income even after the owner has disappeared, right? So, but if your family is surviving on your salary, where you are trading hours or time for money, you need, not want, you need disability insurance. Because while you are driving to work, or while you are driving from work, you can be hit by a drunk driver and be incapacitated, where you need to be in hospital for 6 months, sometimes a year, right? If you have disability insurance, the disability insurance will replace your income. Some replace 100% of your income, some 80%, some depending on what you chose. So if you choose 100% replacement of income, for as long as you are in hospital, or for as long as you are not yet healed, for as long as you are not able to work, you will still get a paycheck at the end of every month. It's like you're still working, but you're not working actually. I've known some people that have been on disability for years, some more. Imagine. Some people who do not have disability insurance, they force themselves to go back to work while they're still in pain, because there was no planning for that. So if you are able, if you have disposable income, it is a good idea to purchase disability insurance, because when you need it, you really need it. Do not keep all your eggs in one basket, because you're not guaranteed that you'll always be healthy. And also, accidents happen at work. While you're working, you can be involved in a work-related accident that forces you to go home and recover. Disability insurance covers that. It keeps your investments. How does it keep your investments? Right? You will not go into your savings. You will not go into your investment portfolio, because there is insurance. Because if you don't, and you are sick and you are not able to go to work, the most logical thing is to begin to go into your savings. Not only that, first of all, you go into your emergency fund, right? You can save your emergency fund by purchasing a disability insurance, where you don't touch it. It's there, but you don't touch it. Why? Because you have insurance. But should your insurance run out, because some have limited terms, some say, we'll pay you a disability for 1 year. After the 1 year, if you're not able to go back to work, you're now on your own. If that happens, then you now begin to use your emergency fund. And if you run out of the emergency fund, then you can begin to use your savings. And usually illnesses like that are normal do not run that far. So insurances, they are very, very important ways of covering for the eventualities, covering for the potential risk, protecting your family from loss of income, bankruptcy, or losing assets. You can lose your house. We'll talk about that as well. In America, if you have a house, you don't actually own it. You may be paid up. You may have finished your mortgage and you believe you own it outright. You don't own it outright. Why is that? There's a clause in the law that mandates you to pay property insurance, right? And if you default on property insurance, the government will sell your house in order to pay for property insurance. So, in other words, it means that the government has a final say on your house. So when whoever has the final say is the owner of your house. But there are some countries where there's no property tax. And once you own the deed, if you have your title deed, you own the house, right? So you have to know also where you are and the laws of your country so that you can prevent things from happening, right? So this information helps us protect our families, because you may believe, I have a house, my children will inherit my house. They may not be able to, because if they miss that year's taxes, property taxes, somebody can actually, this is the funniest thing. Let me explain this, right? Let's say you own a $500,000 house. You have been paying for the past 30 years. Now you're finished paying the mortgage. Now you have a house that is worth $500,000, $500,000. And let's say the tax on it, the property tax on it per year, let's say is $3,000, right? If you fail to pay that $3,000, the government will sell the house for any price as long as they recover their $3,000. So what it means is that somebody can buy your house for $3,000. The government doesn't care about everything else. This what I'm talking about daily in America, in the thousands, people are losing their homes and they are being sold for close to nothing. Secondly, now, if I know there are websites where city councils list houses that have defaulted on their taxes. So here's what I can do. If that same house that is worth $500,000, and I check on the website and I see that you haven't paid your taxes, I can go to the city council and say, hey, so and so has not paid their taxes. I'm going to pay that tax for them, right? I'm going to pay it not for them, actually, I'm going to pay it, right? Do you know that they will accept my payment and change the ownership of the house to me? Yeah, some actually forget to pay. And then if they change the address, the city council sends a mail to the address, say, hey, we are, there's somebody, you have not paid your taxes, but there's somebody who's about to take ownership. And if you don't see that mail, then the the house is gone. Some local governments will auction, and then you lose your property. So you have to know all these things. But like I said, we're going to come back and address those things specifically. You need to know where you are and the laws that apply to you. You may believe that your family is covered when they are not. May God bless you. I will see you again next week, God willing.
Thank you so much, Coach Isaac, for the wonderful eye-opening session that you just shared with us. Every session is very eye-opening. So thank you so much for this. At this moment, I'd like to open the floor for questions, and I actually do see one question in the chat already. So as I read it, if you have any other question, we'll take the next few minutes to answer them. So you can start typing them in the chat, and I'll read the one that's been typed right now. Is there a way to get short-term or long-term disability insurance other than the one offered?
Thank you, whoever asked that question. That's a very, very important question, right? Yes, it just depends on where you are. So this is going to be a very general answer to a very specific question. It depends on where you are. And the best way is to do a research based on where you are, because insurance laws, like in the United States, insurance laws are state by state. There are 50 states here, and each state has its own laws. So, I'm going to say yes and no, depending on where you are. So you need to make a research. You may need to call an insurance agent and ask them this particular question based on where you are. Thank you.
Right. Thank you for the question. Do we have any other questions? Okay, if we have no other questions, we will wrap up with a word of prayer. And as we wrap up, I'd like to say thank you so much to everyone who joined. It is always a pleasure to have you here every week. Thank you, Rachel, for your contribution to the chat, and Beatrice and everyone else who contributed. We sure are looking forward to seeing everyone next week. Next week, make sure you invite a friend or two. We will do a challenge whereby the person who invites the most people gets a reward for it. So please, if you're able to, don't do it just because of the reward. Do it because you care for them, because this will be valuable information. And really, you have nothing to lose. You get a reward, and somebody else's life also, they benefit from this. So let's wrap up with a word of prayer.